Picture yourself in a bustling financial metropolis, surrounded by towering skyscrapers of numbers and charts. Today, we're about to embark on an exhilarating expedition into the intricate world of balance sheets and accounting. Get ready to navigate through the winding streets of financial data and unlock the hidden treasures within these invaluable documents. So, are you up for an adventure that will unveil the secrets behind a company's financial position? Grab your explorer's hat, fasten your seatbelt, and let's embark on this thrilling journey into the captivating realm of balance sheets. Are you excited? Let's dive right in! Unlock the secret to financial success with Counting Coins, where numbers come alive and your accounting game thrives. You know, the balance sheet is a big deal. If you're running a startup, let me tell you, preparing one of these bad boys is an absolute must if you want to stand a chance at securing that much-needed funding. And here's the flip side of the coin. If you ever plan on lending money or investing in a business, you better buckle up and learn how to read and understand the balance sheet. Why? Because it gives you a sneak peek into the financial health of a business, and that determines how risky the opportunity is for you. Oh, and if you're an accountant, well, you'll be tackling balance sheets at the end of every accounting period. It's part of the job. So what exactly is a balance sheet? Picture this. It's a financial snapshot, freezing a business's assets, liabilities, and equity at a single point in time. Think of it as a glimpse into a company's financial soul. On the left side of the balance sheet, you'll find the assets, and on the right side, you'll spot the liabilities and equity. Now, beneath these headers, you'll see all the nitty-gritty details, each group of accounts summarized with their closing balances. It's like taking a magnifying glass to a business's financial standing. Here's a golden rule. Assets equals liabilities plus equity. That's the name of the game. We want those two numbers to be perfectly aligned. It's all about balance. If the total assets don't match the total liabilities plus equity, we have a problem. In the past, people used to manually prepare balance sheets. Let me tell you, it was a colossal pain in the you-know-what. Hours upon hours wasted, even days, trying to uncover the errors in those calculations. But hey, fear not. We live in the era of accounting platforms like QuickBooks Online, the giant of cloud accounting. These platforms ensure that your balance sheet always stays in perfect harmony. Thank goodness for technology, right? Now let's keep our promise and build ourselves a balance sheet from scratch. It's time to dive into the magical world of Google Sheets and create our very own masterpiece. But before we embark on this exciting journey, let's lay the groundwork by understanding a crucial principle: double entry accounting. This principle is the cornerstone of our balance sheet creation. In a nutshell, it means that every accounting entry has an opposite and corresponding entry in a different account. It's like a dance, a delicate balance between what the business owns, which we call assets, and what the business owes. You see, assets are the things the business owns. It's the cash, the accounts receivable, the supplies, the inventory, and the prepaid expenses. These assets are then divided into two main categories: current assets and non-current assets. Current assets are the short-term goodies that can be converted into cash within a year, while non-current assets are the long-term treasures that the business uses to generate profit. They can be easily converted into cash, so we expect to hold on to them for more than a year. Think of things like long-term investments in property, plant, and equipment. It's all part of the assets extravaganza. If you've liked the video so far, please give it a like, subscribe, and let us know in the comments what you would like us to cover next. Now back to the video. Now let's talk about the other side of the coin, liabilities. These are the things the business owes to others. When the business owes stuff to third parties like lenders, suppliers, and employees, we call them liabilities. On the flip side, when the business owes stuff to its owners, we call it equity. See the difference? Liabilities and equity are like two sides of the same coin, each representing different obligations. And just like assets, liabilities are divided into two main categories: current liabilities and non-current liabilities. Current liabilities are the obligations that need to be settled within a year, while non-current liabilities are the ones that will stick around for longer. Think of long-term loans and such. It's all part of the liabilities and equity roller coaster. Next, equity, the final piece of our puzzle. It's a bit different from assets and liabilities. equity is divided into two broad categories: owner's equity and the retained earnings. Owner's equity represents the owner's investment in the business, while retained earnings are the profits held for future use. Now, here's the kicker. Retained earnings form a bridge between the balance sheet and the income statement. They're like a secret pathway connecting the two. But hey, we'll explore this magical link in more detail later. Before we dive into the wonders of Google Sheets and bring our balance sheet to life, let's do a little housekeeping. We want our business sheet to look spick and span, right? So let's add some totals. On the left side, we'll have the total assets, and on the right side, we'll have the total liabilities and equity. These two numbers must match perfectly. It's all about that balance, remember? To emphasize this, I'm going to add a nifty little balance checker that will subtract the total liabilities and equity from the total assets. And guess what? The result should always be 0. Yep, you heard me right. 0. That's the magic number. Now that our balance sheet template is ready and raring to go, it's time to add some numbers. Let's jump into a scenario. Imagine we have a lawn care business. We've covered this scenario in previous videos, like T accounts, journal entries, and the trial balance. We're going to use these transactions again to see how all the puzzle pieces fit together. And hey, a quick side note, the trial balance is not the same thing as the balance sheet. If you want me to explain the differences in a future video, just let me know in the comments. Let's dive into the exciting world of balance sheets with our first transaction. In transaction number 1, the owner of our lawn care business contributes $100 in capital. We'll debit cash by $100 to increase it and credit owner's equity by $100. Balance achieved. Moving on to transaction number 2. Our business takes a $200 loan. We'll debit cash by $200 and credit long-term loans by $200. Balancing act intact. Transaction number 3 involves the purchase of lawn care equipment for $30 in cash. We'll credit cash by $30 and debit plant, property, and equipment by $30, keeping the balance sheet tidy. Now let's tackle transaction number 4. Our business spends $50 on landscaping tools, with payment to be made later. We'll debit tools by $50 and credit accounts payable by $50, keeping track of our liabilities. Hang in there, just a couple more transactions. Transactions 5 and 6 will impact our retained earnings account, connecting the balance sheet and the income statement. In transaction number 5, our lawn care business earns $150 and uses up half of its landscaping tools. First, we'll debit cash by $150 and credit revenue by $150 to recognize the earned revenue. Then, we'll credit tools by $25 and debit cost of sales in the income statement by $25 to account for the tools used and expenses incurred. The balance sheet and income statement working together seamlessly. Lastly, in transaction number 6, our business incurs $20 in repair costs, paid in cash. We'll credit cash by $20 and debit repair costs by $20 in the income statement, keeping a close eye on our expenses. There you have it. We've tracked these transactions, ensuring that our balance sheet remains accurate and balanced. Finally, our balance sheet is complete. We have a grand total of $455 in assets and an equally grand total of $455 in liabilities plus equity. And what about our balance sheet checker? You guessed it. It's showing a big fat 0. That's exactly what we want to see. Now armed with a deeper understanding, you can appreciate how balance sheets play a crucial role in assessing a company's financial health. Whether you're a budding entrepreneur or simply curious about the financial side of businesses, the knowledge gained from this adventure will serve you well. So keep exploring, keep learning, and may your financial endeavors be balanced and prosperous. How do you think a thorough understanding of balance sheets can benefit individuals and businesses alike? Don't forget to comment below with your thoughts, questions, and accounting victories. And make sure to hit that subscribe button and turn on notifications. So I'll see you in the next episode of Counting Coins. Happy accounting!